Hi, I'm Raghav from Globalx. In this video, we look at how geopolitical conflicts dominate headlines, move markets, and where investors could look to find safe havens. So let's get into it. A quick history lesson. Geopolitics and energy markets collided for the first time in early 1970s. In 1973, Middle Eastern oil producers imposed an embargo on the US and its allies over support for Israel during the Yom Kippur War 3 years prior. So here's a long-term look at oil and equity markets. The oil shock produced a combination that economic models struggle to handle: low growth and surging inflation simultaneously. Economists would eventually call this stagflation. It's one of the most difficult macro environments to navigate, offering limited protection from either equities or bonds. Another major shock to markets came in early 2022 when Russia launched a full-scale invasion of Ukraine, and this was Europe's largest war in decades and still not resolved. From a market's perspective, the invasion quickly became a major geopolitical shock. It disrupted energy, commodities, trade flows, and investor sentiments. The start of the war and the subsequent energy sanctions imposed on Russia resulted in a surge in crude oil prices. Crude futures touched their highest prices since July 2008, while the S&P 500 saw a 2.1% one-day drop. So what can we learn? Geopolitical shocks reprice fear premiums and risk premiums much faster than macro fundamentals. Policy risk now matters as much as supply risks do. So if oil prices stay elevated and growth softens, central banks will be forced into a difficult higher for longer narrative that tends to lift yields upwards. Rising global fragmentation has increased focus on investment strategies tied to national security and strategic resilience. For example, investors may look to energy producers outside of the conflict zones, like Canada, for example. Investing in Canadian oil and gas leaders in this environment can serve as a practical hedge when supply shocks through the Strait of Hormuz push crude prices higher. Historically, during periods of sustained supply shocks, energy equities have often outperformed crude over multi-month periods. Instead of relying on a single stock, investors may consider a broader, rules-based approach to investing. The Globalx Equal Weight Canadian Oil and Gas Index ETF, ticker NRGY, which offers equal weight exposure to some of the largest and most liquid Canadian oil and gas companies. Another area some investors may be watching is defense. The situation in Iran reinforces a structurally bullish backdrop for defense as geopolitical fragmentation and regime risks strengthen the support for higher and longer defense budgets across economies. For investors looking for a more diversified approach related to this theme, the Globalx Defense Tech Index ETF, ticker SHLD, or we call it SHIELD, provides exposure to a broad set of companies. SHLD follows a diversified index of companies involved in advancing military systems, technology, and hardware across Europe, North America, and Asia. In volatile markets, ETFs such as NRGY and SHLD can provide differentiated sources of diversified exposures to these themes. Thanks for watching. Don't forget to subscribe, and we'll see you in the next video.